Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
We've got a great one today.
We really do. Today, we're breaking down a true titan of the travel industry, a company you almost certainly used. Booking Holdings, ticker symbol BKNG.
An absolute giant.
Now, on the surface, it's this incredibly profitable global toll booth, but the real question for us as investors is this. Is that toll booth built on an unbreachable fortress, or is it facing a slow, creeping erosion from regulators and tech giants like Google?
That is the core question.
And that's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model.
Okay, let's unpack this. We are diving into a company that really sits right at the intersection of a guaranteed human desire travel and some terrifying technological and regulatory risks.
It's a fascinating setup, really, because when people think of travel, they instinctively think, cyclicality.
Right. Global downturns, pandemics, geopolitical friction. The business just goes up and down with the macro climate.
Exactly. But there's a compelling case to be made for something far more robust here, a global travel matchmaker that might actually be a secular grower disguised as a cyclical.
And that is the million-dollar question we have to answer for you. If they are a secular grower, it means their business quality is just so strong that they can gain market share even when the whole industry is growing slowly.
Right.
So our mission today is to figure out if that's true, or if this incredibly profitable company is just one big tech shift or, one regulatory action away from having its economic moat completely breached.
And I think the central thesis we need to establish right from the start is that we are not analyzing a classic growth stock here.
No.
We are analyzing a highly sophisticated global toll booth operator. I mean, they've positioned themselves perfectly to take a slice of virtually every room booked globally.
So the quality of the business really hinges on identifying precisely why that toll booth is so difficult, maybe even impossible to bypass.
For both sides, right? For the hotels, the supply side, and for you, the traveler, the demand side.
And what makes this so compelling right now is the strategic maneuvering that's going on. We're looking at a company that is actively shifting its core business model.
From being a simple connector to becoming a full transaction controller.
Exactly. And that structural change is what sets the financial stage for the next decade. So let's jump in.
Let's do it.
So when you look past all the brands, Booking.com, Agoda, Priceline, Kayak, the fundamental model is, it's pretty simple. And that simplicity is what makes it so durable.
It's a 3-step process, really.
Right. First, aggregate supply. Second, aggregate demand. And third, take a toll. What makes you so confident that this model is durable for the next, say, 10 or 20 years?
Well, it really just comes down to basic human economics.
The structural driver.
Exactly, the structural growth drivers.
Yeah.
That fundamental desire we all have to explore, to travel, see the world.
Reconnect with family.
All of it. It's just intrinsically tied to rising global GDP.
Right. And the expansion of the global middle class.
And that's the key. Travel demand, it might get paused by a recession, sure, but it always, and I mean always, snaps back stronger.
So it's not a fad. It's a structural part of life.
It's completely structural. And that scale is necessary because, travel supply is incredibly fragmented.
Totally. The need for a trusted middleman to sort through literally millions of options, to find the best price, confirm availability instantly, offer a layer of trust, that need for an aggregator is just enduring.
It is. No matter how many apps or AI assistants pop up, someone still has to do the heavy lifting of, managing the inventory and assuring the transaction.
Okay, so let's detail how they actually monetize this durability, because this is where a major strategic shift has happened.
Right. Historically, their bread and butter was the agency model.
The classic setup.
The classic setup. The customer books on Booking.com, but they pay their hotel directly after the stay.
Oh.
Booking then collects a commission from the hotel later, maybe 15%. It was very asset light, very low risk.
But they've actively pivoted to accelerate the merchant model, and this is now the clear engine of the business, right? It's something like 60% of their total revenue and growing. So why make that shift, especially when the agency model was so comfortable and, like you said, so asset light?
That's a vital question, because the comfort of the agency model was actually deceptive. While it was asset light, they had almost no control over the customer's payment experience, and critically, zero control over the cash flow.
I see.
So the strategic reason for shifting to the merchant model is really threefold. It's about control, bundling, and financial float.
Okay, control over the payment sounds significant, but how does that actually translate into better business quality?
Well, under the merchant model, you, the customer, you pay Booking Holdings up front when you reserve the trip.
Right now.
Exactly. Booking then sends the net amount to the hotel provider later, sometimes weeks later after the stay is already done.
So by putting themselves directly in the payment flow, they gain full oversight.
Full oversight.
Yeah.
And this allows them to bundle services much more effectively. You can't easily package a flight, a hotel, and insurance if you don't control the money.
And it deepens their control over the transaction, which makes it much harder for basic competitors, especially those simple meta search engines, to come in and displace them.
Exactly.
Wait, but if they control the payment flow, doesn't that expose them to massive new risks? I'm thinking like credit card fraud, chargebacks, bad debt, things that the original asset-light agency model completely avoided.
That's a great point. And yes, they absolutely take on more operational complexity and risk, but they manage it through scale and, frankly, expertise.
So why is that risk worth the increased control?
The risk is worth it because controlling that payment process is the foundation for two critical advantages. First, the stickiness of the connected trip, which we'll get to later.
Okay.
And perhaps most importantly, the massive financial leverage created by the negative working capital cycle.
Right. They're essentially building an in-house banking function that uses customer deposits.
You've got it. The financial benefit of holding billions in customer cash far outweighs the marginal fraud risk, especially when you have their massive transaction volume.
So we've established the model is durable, and the shift to merchant gives them financial control. But the key to the whole thesis, the defense against competition, is the moat.
It's all about the moat.
And the primary moat is, well, it's clear as day. Network effects, specifically the sheer scale and quality of their two-sided platform.
The numbers required to maintain this network effect are just staggering. I mean, Booking doesn't just aggregate mainstream hotels. They have over 29 million listings globally.
And this is key. 7 million plus of those are alternative accommodations.
Right. Homes, apartments, the very segment that Airbnb pioneered. By having this massive hybridized inventory, they just become an indispensable utility.
And that massive supply base attracts demand, and demand attracts more supply.
It's the virtuous cycle.
It creates this inescapable gravitational pull. It makes it, it's practically financial suicide for any significant hotel, whether it's a large chain or a small independent, not to list on Booking.com.
Even if they deeply resent paying that commission. Let's use that tangible example that really drives this point home. Imagine a small, boutique, family-run hotel in Florence, Italy.
The one with 5 rooms and incredible reviews.
That's the one. Now, how can that hotel efficiently spend advertising dollars to reach a specific tourist who lives in, say, Seoul or in Johannesburg?
They can't, or at least they can't afford to.
Exactly. Booking is the only efficient instant bridge between that hyper-fragmented supply and that global fragmented demand. They solve a huge marketing problem for the hotelier.
And because they solve that problem, the problem of reaching the marginal customer, that gives them something the market often misses.
Which is?
Pricing power disguised as a take rate. People focus on that 15 to 20% commission the hotel pays, and they just assume it's a fixed cost of doing business.
But it's not. It's a tax on distribution.
Precisely.
Right.
Hotels pay that 15 to 20% because Booking provides the marginal customer that fills the room.
Right. The hotel would much rather give up 20% of the revenue than have that room sit empty.
So Booking dictates the commission structure because they effectively own the demand funnel. If you, the traveler, stop using Booking, those 29 million listings suddenly lose their global audience and the moat just collapses.
But as long as the 29 million listings are there, the demand has a very compelling reason to follow.
This connects perfectly to some foundational mental models for understanding digital platforms. If you look at, say, Ben Thompson's aggregation theory,
Booking is the textbook case.
it really is. They aggregated supply at all those hotels and homes at near zero marginal cost because they don't own the inventory. But by becoming the default interface for demand, they accrue all the value to the platform.
And they effectively commoditize the underlying supplier, the hotel itself. The hotel loses its direct relationship with the customer.
So if we take that one step further and we apply Charlie Munger's concept of the Lollapalooza effect.
Now you see why the barrier to entry is basically insurmountable for any new online travel agency or OTA.
Right, because the Lollapalooza effect isn't just four advantages adding up.
No, it's four advantages multiplying each other, creating a non-linear compounding force.
Okay, so walk us through those four compounding factors. Why is this more than just a sum of its parts?
So the four advantages are scale, brand, technology, and marketing spend. First, you have the massive inventory, 29 million listings.
Check.
Second, you have dominant global brand recognition that drives huge organic traffic. Third, you have decades of transactional technology expertise.
And fourth, the biggest barrier of them all.
The $6 billion plus they spend annually on performance marketing, most of which goes straight to Google.
So a new entrant wouldn't just need $6 billion to start advertising.
No, they need $6 billion plus the existing network effect, plus the trust factor to even begin to compete.
It's like trying to start a rival social network against Meta, but the barrier is pure cash you need just to get in front of the customer.
Precisely. That compounding effect means that trying to raise the capital, build the brand awareness, and simultaneously acquire the supply necessary to offer a comparable utility to Buplay. Booking is just, well, it's mathematically prohibitive.
This fortress wasn't built overnight.
And it cannot be replicated by simply throwing venture capital at the problem.
Okay, we've covered the cold, hard mathematics of the moat. But what about the human element? Before we get to the customer reviews, what exactly do we mean by scuttlebutt simulation here?
So scuttlebutt is an old Navy term for eavesdropping on conversations. It means gathering intelligence by listening to what people are saying outside of the official company reports.
I see.
A scuttlebutt simulation is when you synthesize that real-world ground-level feedback from customers, employees, suppliers to gauge the true health of the business model. It's about assessing soft factors like brand sentiment and employee morale.
And based on the scuttlebutt, it sounds like customer love for Booking is, shall we say, mixed.
That's a polite way of putting it. They are not an aspirational brand like Apple or LVMH. They are utility.
The very definition of a tolerated utility.
Exactly. Customers appreciate the volume, the sheer number of options is unmatched, and their Genius loyalty program, which offers instant tiered discounts, is highly effective at making sure the pragmatic, price-sensitive traveler returns.
But the emotional connection is low.
Very low. I can certainly attest to the friction. When a cancellation happens or a flight is delayed, dealing with customer service can be agonizing. You feel stuck in the middle.
That's the inherent downside of being the middleman, and it's a necessary trade-off for efficiency. When things go wrong, the customer service process becomes opaque.
Right. The traveler doesn't know if the fault lies with the hotel's inventory system or Booking's payment gateway.
And Booking takes the brunt of that complexity and friction because they own the transaction.
And this complexity is precisely why companies like Google have historically avoided becoming a full OTA.
So the poor customer service experience in complex situations isn't necessarily a sign of management weakness.
No, it's an inherent operational cost of running a global, multi-currency, multi-jurisdictional, two-sided platform. It's the cost of scale.
Okay, so shifting to the employee perspective, the internal culture is described as a rational, high-performance financial meritocracy.
Right. Compensation is excellent, which is typical for a dominant tech platform that generates this much cash flow. People are highly incentivized to optimize profits.
And yet, we see some internal friction, particularly around the integration of their brands, Agoda, Kayak, Priceline under the CEO's central vision of the connected trip.
That friction is absolutely worth noting. These brands are highly successful, independent silos, often with deeply entrenched management teams and distinct regional focuses.
So trying to unify them, forcing them into a single technological and cultural umbrella, that's always going to generate resistance.
Always. The goal is efficiency and cross-selling, of course, but the immediate result is often turf wars and cultural clashes.
But the key takeaway here seems to be that the internal friction is operational and cultural, not existential.
That's a good way to put it. The machine is functional and hugely profitable, even if the parts don't always hum in perfect harmony.
Okay, so before we transition to the financials, we have to clearly define the competitive landscape. Booking faces three massive rivals, each attacking from a different angle.
Expedia, Airbnb, and the existential threat, Google.
Let's start with Expedia Group, EXP. This is the direct head-to-head OTA rival. They're fighting over the same customers with very similar business models.
They're V-shaped competitors for sure, but they have key differentiations that define their respective markets.
Right. My understanding is that Expedia is historically much stronger in the U.S. market, focusing on vacation package bundling.
While Booking just dominates international.
Why is that?
Well, Booking's early aggressive investment in fragmented international markets, Europe and Asia, gave it an almost unassailable lead there.
Yeah.
In those regions, the hotel ecosystem is less concentrated and far less sophisticated digitally. That makes the OTA bridge Booking's service far more vital for the small and medium-sized providers.
Okay, so it's a structural advantage, and Expedia is stronger in corporate travel, B2B.
Traditionally, yes. Though both are moving into each other's territories, their battle is primarily one of operational efficiency and geographical expansion, not one of fundamental business model disruption.
Then you have Airbnb, ABNB, the disruptor that owns the brand for unique, local, and aspirational stays.
They really did capture a demographic that fundamentally changed how people think about accommodation.
Right. Airbnb sells an experience. Booking sells utility. So what is Booking's defense?
It's pragmatic and twofold. First, they dramatically expanded their supply of hybrid inventory, those 7 million alternative accommodations we mentioned.
And second,
More importantly, they offer the integrated search. A traveler can search for a 5-star hotel or a unique apartment home in a single search, using the exact same filters.
so the pragmatic traveler, the one who's optimizing purely for price, location, availability, who doesn't prioritize the uniqueness of the stay.
They're going to stick with Booking because it's a single-point solution. It's just easier than checking 2 different platforms.
It's an efficiency moat against an aspirational moat.
Precisely. Airbnb created the category, but Booking is consolidating it by appealing to the practical consumer who values comprehensive choice.
And finally, we have to address the gatekeeper, the sword of Damocles. Google, GOGL.
This is the only company that could truly upend the industry.
Because Google owns the top-of-funnel search traffic. They are the initial touch point for, maybe 70 to 80% of all global travel intent.
At least. The relationship right now is one of, let's call it, uneasy symbiosis. Booking spends over $6 billion a year on performance marketing, and a huge chunk of that goes straight into Google's coffers.
To secure those high-traffic search terms like hotels in London.
Exactly. So Google gets massive ad revenue, and Booking gets the leads it needs to monetize its supply.
But why hasn't Google just cut out the middleman? They have the traffic, they have the technology. What keeps them from becoming a fully transactional OTA?
It really boils down to 3 factors: complexity, risk, and regulation.
Okay.
As we discussed, handling millions of global travel transactions, managing complex multi-language customer support, dealing with payment disputes, juggling regional tax complexities. It's a messy, low-margin operational headache.
And Google's strength is search advertising, which is a near 100% margin business.
Exactly. Why would you trade high-margin advertising revenue for low-margin operational risk?
And then there's the regulatory angle.
Huge. If Google became a full OTA, it would just ramp up the already intense antitrust scrutiny it faces globally. It would be seen as abusing its search dominance to crush a vital partner.
So that distinction, gatekeeper versus transaction handler, is the central tension.
It is. Booking's reliance on Google is its largest operational cost and its biggest existential risk.
Okay, moving from the competitive fortress to the treasury, we need to analyze the people running the show. CEO Glenn Fogle, who's been leading the charge since 2017, he seems to have a very clear mandate.
Fogle embodies a rare combination in modern tech leadership. He's a disciplined operator with a true capital allocator's mind.
His philosophy isn't about chasing growth at all costs, which you see all over Silicon Valley.
Not at all. His philosophy is firmly rooted in profitable growth. He understands that $1 of revenue is meaningless if it costs 95 cents to acquire.
And we see that philosophy reflected directly in how the management team gets paid, which is critical for long-term investors.
Absolutely. Their incentive structures are heavily weighted toward performance-based stock units, PSUs.
And those are explicitly tied to 3-year targets for both revenue and adjusted EBITDA.
That compensation alignment is the engine of their operational discipline. They aren't incentivized just to increase top-line sales, which is often easier to do. They have to do it while actively maintaining or expanding profitability.
Which prevents reckless spending and protects those high margins we were talking about.
Exactly. And we have to give them incredibly high marks on what you could call the rationality test for capital allocation.
You mean looking back at the zero interest rate era, the period between, 2015 and 2022?
Right. When tech companies were on a frenzy of massive, often reckless acquisitions, all fueled by cheap capital.
Bookings showed immense restraint.
Immense. They held significant cash. They avoided the impulse to just buy marginal non-core assets because capital was free. They focused internally on platform integration, and crucially, they bought back their own stock when the market was valuing them cheaply.
Especially during travel shocks.
Exactly. That disciplined track record suggests a maturity that's often absent in high-growth companies. They're prioritizing shareholder value by being counter-cyclical with their own stock.
And the recent signal they sent to the market really formalizes this maturity.
The initiation of a dividend.
Yes, that dividend initiation is powerful. It's management communicating to the financial world, we are transitioning. We are no longer solely focused on reinvesting every single dollar back into the business for marginal growth.
They're saying we are a disciplined, mature, self-sustaining cash cow.
And it signifies confidence that they can both fund internal growth projects and return substantial capital to shareholders.
Which brings us to the famous Cannibal metaphor.
Right. The massive percentage of their share count retired over the last decade through aggressive, disciplined buybacks. For the listener, why is this capital return policy so crucial to the investment thesis?
Because it's a primary non-operational driver of their earnings per share, their EPS growth. I mean, think of it this way. When a business model is so asset-light that it consistently generates far more cash than it can profitably reinvest internally.
And you remember that stellar ROIC we hinted at?
Exactly. When that happens, the best thing management can do is shrink the number of shares outstanding.
So if the company earns, say, $10 billion in net income, and they reduce the share count by 5%.
The EPS automatically grows by 5%, even if the net income stays flat.
They are engineering EPS growth by relentlessly reducing the denominator.
Yes. It's a financial engineering layer built on top of the robust operational model. And it's not a temporary fix. It's a long-term capital strategy. They buy back stock when fear drives the multiple down, which increases the long-term compounding rate for disciplined investors.
And the dividend just confirms that management views capital returns as a core function now. It's an acknowledgement that the business has reached a point where the flood of free cash flow is just so strong that it needs multiple avenues to get back to shareholders.
Which ensures the capital doesn't get squandered on low-return vanity projects.
Exactly. Okay, let's break down the key financial quality indicators because this is where the inherent superiority of the business model really shines through. The financial fortress is, well, it's pristine.
It really is.
Let's start with profitability. We're talking about operating margins that are consistently north of 30%.
Which is exceptional for any company, especially one operating in a highly competitive consumer-facing industry.
So how do they do it?
That 30% margin is the definition of a scale business built on an asset-light model. They aren't maintaining hotels, managing airlines, or employing large fleets of vehicles. They manage data, they manage technology, and they manage transactions.
Their primary costs are performance marketing, paying Google, and technology development.
Right. And once you hit scale, the incremental cost of adding a 30th million listing is virtually zero. That allows the margins to just balloon.
But the true mark of operational quality is the return on invested capital, or ROIC. What kind of numbers are they posting, and what does it tell us?
So, excluding that brief exogenous COVID disruption, Booking consistently achieves ROIC figures between 25 and 30%.
That's exemplary.
It is. And it tells you two critical things. First, every dollar of retained earnings or capital they deploy internally is used with extreme efficiency. And second, this is more important, they require very little capital to generate growth.
No huge factory build-outs or massive physical assets.
None. This consistently high ROIC means the business is creating value far faster than nearly all of its peers.
Now, we need to focus on what I consider the single most crucial, beautiful detail, the financial superpower that underpins the entire cash flow profile.
The negative working capital cycle.
Yes. This sounds like jargon, so let's slow down and explain exactly what this means and why it's so powerful.
Okay, so this cycle is why their net income converts to free cash flow FCF at nearly 100% and often far more.
And it goes back to the merchant model we discussed.
It all comes back to that. Let's walk through the timeline. Say you book a trip in March for a hotel stay in July. Under the merchant model, day one, you, the traveler, pay Booking Holdings the full amount.
Okay, so Booking has my cash immediately.
Correct. But Booking is not required to pay the hotel until after your stay, usually sometime in August. So for 5 months, Booking has the customer's cash sitting on its balance sheet.
So they're operating on an interest-free loan from millions of customers worldwide simply by being the necessary transaction matchmaker.
That's it. Wait, so they're essentially earning interest on money they don't own? They are a travel company that gets paid to hold cash?
That's the most accurate way to frame it. This mechanism creates a massive interest-bearing float. We're talking about billions of dollars of customer cash held for long periods.
And here's why it's particularly critical today.
Higher interest rates.
In a sustained higher interest rate environment, that float becomes exponentially more valuable. They are earning risk-free interest on money that isn't their capital, which provides a margin-enhancing cushion that pure-play, capital-intensive tech companies simply do not have.
That detail is often severely underestimated by the market.
Massively.
Okay, now that we understand the financial quality and that financial float, we need to atone to the external threats. The competitive landscape is dense, but Booking has clear strategic differentiations against its massive rivals.
We covered the high-level distinctions earlier, but we really need to dive deeper into the strategic battles. Take Expedia Group first. While you're head-to-head, their competitive strategy is different.
Right. Expedia relies more on bundling vacation packages to increase customer lifetime value, and they have that powerful loyalty program, One Key.
Designed to keep U.S.-based travelers locked in. But Booking's dominance in Europe and Asia, that seems like the true differentiator. Why is the fragmentation of those markets such a persistent moat?
Well, because the Asian and European markets contain vast numbers of tiny independent hotels, guest houses, and regional chains that just lack the technological sophistication to run their own global marketing campaigns.
So for these places, the cost of acquiring a single customer from another continent is astronomical.
Completely. Booking provides a one-stop shop for global distribution, a service the small operators cannot replicate. This structural advantage insulates Booking from the rivalry with Expedia, allowing them to compete on a superior geographic footprint, not just on pricing.
Okay, now let's look at Airbnb. While they're the aspirational brand for unique stays, how exactly is Booking's hybrid inventory search implemented in a way that truly blunts Airbnb's growth?
Well, Booking views alternative accommodations, those homes and apartments, as just another inventory type, not a separate philosophy. They integrated those 7 million-plus listings directly into the standard search interface. When you search for Paris accommodation, you immediately see hotels, hostels, and apartments side by side, ranked by price and relevance.
Whereas Airbnb requires a philosophical commitment to the home concept.
Exactly. Booking appeals to the shopper who might prefer an apartment but still needs the option of a hotel if the price or location is better. This strategy steals market share from Airbnb by removing the friction of having to switch platforms.
It's the pragmatic approach versus the philosophical approach.
You got it. And then there is the elephant in the digital room, Google. We noted that Booking spends over $6 billion annually on performance marketing, essentially feeding the beast.
This is the single biggest sign of their vulnerability. If Google were to suddenly optimize its own travel products, that $6 billion becomes wasted overnight, and Booking's margins are crushed.
So if the relationship is symbiotic now, how long can that uneasy truce last? Especially since Google has the technical capability to handle transactions.
The truce lasts as long as the operational headache and the regulatory risk outweigh the financial temptation for Google. The moment Google perceives that Booking's margins are high enough to justify the regulatory risk and the operational complexity of customer support, that truce ends.
Which means Booking must actively deepen its moat to survive this.
They have to. Which brings us to the core growth engine, the connected trip.
To defend against Google and to expand their total addressable market, CEO Fogle's central strategy is the connected trip. This isn't just an optimization, it's a fundamental strategic, defensive, and growth maneuver.
It's all about vertical integration.
So what's the definition of the connected trip?
It's simple. Moving from being a platform that sells just the hotel room to becoming the platform that sells the flight, the car rental, the insurance, the airport transfers, and local attractions, all in a single seamless order.
A single ecosystem. Why is this so crucial for their competitive positioning?
First, it dramatically increases the total addressable market, the tamper user. If you only sell a hotel room, you capture maybe $1,000 of the traveler's budget.
But if you sell the entire $3,000 vacation package, you capture 3 times the value.
Right. And second, and this is the defensive part, it creates a significantly stickier ecosystem.
Because a customer who uses Booking for the flight, the car, and the hotel has already invested significant time and data into that ecosystem, it makes it painful to switch.
Precisely. If you book your entire itinerary through Booking, you are highly unlikely to use a competing meta search engine next time, or a single-service competitor like a standalone flight aggregator.
And this deepening of the ecosystem is designed specifically to deepen the moat against pure search engines like Google.
It forces Google to choose. Keep the high ad revenue, or attempt to disrupt a highly complex, vertically integrated platform. It's a very strategic gamble.
Okay, so for every strong bull case, we have to scrutinize the bear case. And there are 2 major existential threats. The first is immediate and tangible: regulatory gatekeeper status.
This is a massive structural concern, particularly in Europe, which is Booking's largest and most profitable market.
The EU's Digital Markets Act, the DMA.
Right. It targets companies deemed to have gatekeeper status, which Booking absolutely does. And the most harmful potential outcome of the DMA is that the EU will force them to remove what are known as rate parity clauses.
Okay, let's make sure we all understand this mechanism. Historically, Booking mandates that a hotel cannot offer a cheaper rate directly on its own website than it offers on Booking.com. Why is that mandate so important to Booking's utility?
Well, rate parity protects Booking's value proposition. If a customer knows they can always find the lowest or at least an equal price on Booking, they have a reason to start their search there.
And they benefit from the massive selection and the review system.
And it justifies the 15 to 20% commission because Booking guarantees the demand side won't undercut the supply side.
But if the EU forces Booking to abandon rate parity, the competitive dynamics fundamentally change overnight.
They absolutely do. If a hotel can legally offer a 5% cheaper rate directly, the incentive for the consumer is massive.
Bypass the OTA, book directly, save money, and probably get better customer service from the hotel itself.
Right. And this could lead to a structural, permanent decline in Booking's effective take rate across its largest market. They'd have to aggressively lower commissions just to keep the hotel inventory on the platform.
Which would crush those stellar 30% operating margins.
Crushed. That is the immediate, tangible regulatory risk.
And the hypothetical long-term threat remains Google becoming a fully transactional OTA. If Google dedicates its massive AI capabilities to replicate the customer service and transactional layer, the messy part, Booking's expensive $6 billion+ traffic source, could dry up overnight.
Or just become prohibitively expensive. That's the ultimate sort of Damocles. It requires a judgment call on Google's long-term intentions and its tolerance for regulatory pain.
The risk is less about technical capability and more about strategic intent and antitrust constraints.
Exactly.
Okay, flipping the script. What are the internal and external catalysts that could generate alpha and drive the stock higher in the next few years, assuming the regulatory storm is managed?
I see 2 primary drivers. First, the successful deployment of advanced AI trip planner and customer service capabilities.
Right. We noted that customer service is a massive operational friction point for them.
And an enormous cost center, given the volume of global transactions and cancellations they handle.
So if they successfully deploy generative AI agents to drastically improve the customer experience,
Addressing that mixed customer love we talked about.
and simultaneously automate the resolution of, say, 80% of routine inquiries, that would lead to enormous cost savings.
And that improvement in efficiency would drop directly to the bottom line, expanding margins even if revenue growth slows down.
The second catalyst is entirely financial, and it's tied back to that cannibal metaphor.
Capital return acceleration. If the stock price lags behind the actual earnings growth, for instance, if macro fears or regulatory rumors cause the PE multiple to contract management has a pristine balance sheet.
Zero need for massive capital expenditures.
And billions in annual free cash flow. They can significantly increase the buyback pace, thus accelerating earnings per share growth, even without a huge bump in revenue.
And they're disciplined enough to buy aggressively when the stock is cheap.
Which makes buybacks a very reliable source of alpha.
Okay, let's talk valuation. The market perpetually struggles with how to value Booking holdings.
It does. Historically, it trades at a premium to the general stock market, which reflects its quality, its dominance, its high ROIC.
But it trades at a discount to hyper-growth tech stocks.
Because of those two persistent fears, cyclicality and terminal Google risk.
So it often exists in that middle ground, historically trading around 20 to 25 times price to earnings. The question for the disciplined investor is, when is the right time to buy such a high-quality compounder?
Yeah. And how do we define an adequate margin of safety?
Right.
Well, based on historical patterns, a clear margin of safety seems to exist when the stock trades at a free cash flow yield of 5 to 6%.
Which approximates a price-to-earnings ratio of less than 20.
Exactly. When the market fears are peaking, that is when the quality shines through at a reasonable price.
And historically, buying BKNG during travel interruptions, times when the multiple temporarily contracts due to fear, has been a massive generator of alpha.
We're talking about buying during macro scares, geopolitical wars, recession fears, or massive exogenous travel shutdowns. The pattern holds because the business quality endures.
The structural need for a global aggregator doesn't disappear just because people pause travel for 6 months.
The business snaps back and the multiple expands once the fear subsides. The challenge today is that the price already reflects a strong recovery from those lows.
So future returns will depend entirely on whether the success of the connected trip and the aggressive EPS growth from buybacks can outpace any potential compression of the valuation multiple due to those structural risks.
Which brings us to the core tension: the market consensus versus the contrarian opportunity.
The market consensus is simple. Booking is a mature cyclical stock tied directly to the global economy. When the economy slows, travel slows, the stock gets hit. You're simply betting on the global business cycle.
Right. But the contrarian view, and what makes this thesis so compelling for a long-term investor, is the idea that Booking is a secular grower disguised as a cyclical.
Meaning they are structurally positioned to gain market share even if overall global travel growth is sluggish.
Precisely.
So how does that market share gain happen if the overall pie isn't expanding rapidly?
Two primary reasons, both rooted in structural change. First, the expansion into alternative accommodations and that merchant model shift allows them to aggressively consolidate market share from two sources.
From traditional non-digital channels, that Florence hotel owner who finally puts their rooms online,
And from direct rivals like Airbnb by appealing to the pragmatic customer. They're digitizing a fragmented industry.
so they are consolidating the market, which is a secular trend, regardless of whether the economy is booming or contracting.
Absolutely. The second reason, which loops back to the financial profile, is the market's underestimation of the financial float.
The benefit of earning interest on billions of dollars of customer cash in a sustained high interest rate environment.
It provides a margin-enhancing cushion that insulates the bottom line from moderate cyclical dips. This financial superpower makes the earnings stream far more resilient than a pure-play cyclical stock.
Okay, so let's end our analysis with the red team challenge, the strongest arguments against the bullish thesis.
We have to articulate the death by 1,000 cuts scenario.
Let's assume the worst.
Yeah.
We are buying this company at a peak earnings cycle, meaning the next structural direction for margins is down, not up. What are the contributing factors to margin decline?
Well, the argument is that the connected trip adds lower margin revenue, which dilutes overall profitability.
Flights, car rentals, attractions.
All have notoriously tiny margins compared to the core hotel booking business. Adding low margin volume just increases top-line sales without improving the core profitability profile.
And it requires ever-increasing capital investment in technology and customer service to support that complexity.
Exactly. And simultaneously, the regulatory pressures are mounting. The European Union succeeds in breaking the rate parity clause,
Which leads to a structural, permanent decline in the effective take rate across their largest market. That is a permanent reduction in the value of their network effect.
And finally, the ultimate fear: the supply side fighting back. Hotels finally succeed in mounting direct booking campaigns using new advanced AI tools, personalized marketing, and direct loyalty programs.
Effectively bypassing Booking's toll booth on a massive scale.
And if all these structural pressures hit simultaneously, margin dilution from the connected trip, take rate decline from regulation, and a supply-side revolt, then you're currently paying a premium multiple for a business whose moat is slowly leaking.
Even if the absolute earnings numbers look good today.
Even then.
That is the tightrope walk for the investor. You're owning a wonderful business with an undeniable competitive position, but you're watching closely for those structural erosions to the take rate and the increasing power of the gatekeeper becoming a competitor.
So what does this all mean for you synthesizing these complex layers?
We've established that Booking Holdings is defined by three powerful structural advantages. First, its massive, difficult to replicate network effect, the sheer volume of supply and demand it commands.
Second, its disciplined capital allocation strategy, which has turned them into the Cannibal through relentless share buybacks.
And third, the strategic shift to the merchant model, allowing them to control payments and create that powerful financial float.
The central tension, however, remains squarely focused on external forces that are beyond management's control. Can Booking's structural moat withstand the increasing regulatory pressure from the EU seeking to break the rate parity mechanism?
And the ever-present technological threat posed by Google, the gatekeeper. These are structural, not cyclical risks.
They are. We look for quality businesses that compound, and this is one. But we have to be perpetually mindful of the price we pay and the structural integrity of that competitive fortress.
Which faces threats from regulators and technology alike.
Which leaves you with a really interesting question to think about.
Right.
Given the success of the merchant model, Booking Holdings holds a substantial interest-bearing customer cash float. It's a financial asset.
Okay.
In a world where interest rates remain elevated, fundamentally higher than the last decade.
Yeah, not going back to zero.
Exactly. So should we really be valuing Booking just as a tech or a travel company based on earnings multiples? Or do we need to start thinking about it as a kind of, a highly sophisticated asset-light financial entity that literally gets paid to hold its customers' money?